Sarah is the general manager of Paradise Hotel. She's obsessed with net income, also known as net profit and other names. She often tells her colleagues how she's proud of the net income dollars her hotel has earned. Although she's only focused on her net income dollars, she has ended up with a 10% return on equity. She feels on top of the world. One day, her owner walks into her office and asks why their competitor is earning twice the return Sarah has achieved. Sarah is shocked, but immediately jumps to defend her net income. However, the owner wants to know why they had missed opportunity for a better return on equity. Indeed, Sarah had gone after the profit dollars. On the other hand, return on equity had suffered disastrously. She missed a huge opportunity, something that her competitors had not done. In the hotel industry, many general managers fall prey to what is known as vanity metrics. Simply stated, these are metrics connected to egos more than realistic business rationale. However, return on investment fundamentals talk about the power of comparing return to the investment made. It's like knowing what is at stake. You should not measure a result without a comparison to what is at stake. Net income is single-dimensional. It ignored the disastrous effect on return on equity, which is the investment itself. Equity is known as the investment. She might have prevailed on the profit dollars, but had hopelessly lost on the bigger return on investment principle. This forced Sarah to change her ways. She now turned her attention to the more powerful return on investment and return on equity metric more specifically. Sarah does not use absolute measures anymore. She looks at a metric in relation to the invested dollars. In this case, it happens to be equity. She also made a key change to the profit dollar KPI as well. Let's compare the before and after scenarios. Sarah now uses a better profitability KPI, EBITDA. Instead of net income, she will measure EBITDA as the return on her equity. What is EBITDA and why has she chosen this metric? Let's look at the Paradise Hotel's profit and loss statement to find out. Notice how net income is after deducting all expenses, while EBITDA only deducts operating expenses. What's the difference, you want to know? Return on investment calculations use the operating profit EBITDA for return on investment, including return on equity calculations. This means considering only operating expenses and indicates operational efficiency of the investment itself. Here are 3 points where net income and return on equity conceptually differ. Sarah is achieving a 10% return on her equity, although she was calculating it incorrectly using net income. With a new learning, Sarah took quick action. She changed her focus to the return on equity measure. She also made the KPI change for the return itself. EBITDA is now central to her return goal. EBITDA is the correct measure for operational efficiency, which will be reflected in a return on investment, including return on equity calculation. EBITDA is showing a better return on equity as compared to net income. Sarah understood the importance of using the right metric for return on investment calculations. Of course, she also learned her lesson in not just looking at profit dollars. So, what's the moral of the story? Net profit is what you call vanity, while return on equity is sanity, if you want to put it that way. But more importantly, the key difference between an absolute and a relative measure: net profit is a absolute measure, return on equity is a relative measure, as in it takes into account the investment also made apart from the return itself. Sarah is better with a new financial literacy gain on two factors of return on investment calculations. Let's look at takeaways. Realize that net income is a single dimensional metric, while return on equity is multidimensional. Moreover, EBITDA is a better KPI than net income since it is an operational focused metric. Interested in knowing the full truth about the concept of the return on investment itself? Watch above video on how to calculate return on investment.